Exercise 7-27 is preparing incremental analysis concerning the elimination of divisions. So Nicole, a recent graduate of Rawlings University's accounting programs of Poway's Company's 6th Division. Nicole made the following presentation to Poway's directors and suggested that the Erie Division be eliminated. If the Erie Division is eliminated, she said, our total profits would increase by $23,870. So the information given is sales, cost of goods sold, gross profit, operating expenses, and net income. So right now the other 5 divisions have sales of $1,664,200. Cost of goods sold is $978,520, and a gross profit of $685,680. The operating expenses are $527,940 to get net income of the other 5 divisions of $157,740. Currently, the Erie Division sales are $96,200. Their cost of goods sold was $76,470, so their gross profit is $19,730. The operating expenses are $43,600, so there's a net loss of $23,870 for the Erie Division. And then the totals are given as well, so net income for all 6 divisions is $133,870. So we're just worried about the Erie Division. In the Erie Division, the cost of goods sold is $70,000 variable and $66,470 fixed. The operating expenses are $15,000 variable and $28,600 fixed. None of the fixed costs will be eliminated if discontinued. So we need to figure out if she is right about eliminating the Erie Division. So we know the value currently of continuing. It's given in the question. So we know that net sales are $96,200, variable costs are $85,000, the contribution margin is, then the variable costs are $85,000, which are given. They said that $70,000 are variable and $15,000 are variable of the operating expenses, so we have a total of $85,000 of variable costs, which means the contribution margin for the division is $11,200. The fixed costs are the $64,770 from cost of goods sold and the $28,600 from the operating expenses, so the total fixed costs are $35,070 for a net loss in the division of $23,870. So we've just reallocated. In the question, they gave us cost of goods sold and operating, and now we're just dividing up, instead of by cost of goods sold and operating, by fixed and variable. So the variable costs are coming from $70,000 in cost of goods sold and $15,000 in operating, and the fixed costs of $35,770 are coming from $640,770 from cost of goods sold of fixed and $28,600 of fixed from the operating. So we've just reallocated them by fixed and variable for internal purposes. Now we're going to look at, well, what's the value if we eliminate? Well, we'd have no sales, no variable costs, so we wouldn't have any contribution margin. However, it says none of the fixed costs can be eliminated. So we'd still have $35,700 in fixed costs, which means we'd have a net loss of $35,070. So if we eliminate the division, we actually lose the contribution margin of $11,200 from that Erie Division, because we still have to cover those fixed costs. So really, we should continue, we should not eliminate Erie, because our loss would be higher if we did, because the fixed costs that we would still have to incur are more than the current net loss of the division. Okay, because we can't avoid them. They're not relevant in our decision. We want to make sure that basically what we're doing is we're losing our contribution margin. We have those fixed costs regardless, so we're losing any contribution. So as long as, if fixed costs stay the same, whether we close a division or not, we need to look at, do they have a positive contribution margin? If they do, we would want to continue with that division.